Stop. Before you dismiss today's move as noise. Before you reach for the exit because you've seen big sessions before. It is Monday, February 23, 2026, and silver is trading between $86.90 and $87.30. A 6% intraday surge, a fourth consecutive daily advance, outperforming gold by 3 to 1 on the exact same catalysts. I know some of you sold too early after the Friday close. I know some of you are watching from the sidelines. The answer is the same in both cases. The structure is stronger today than it was last week. President Trump just escalated tariffs to 15% using legal authority never before invoked in United States history. Iran has not blinked. The sixth consecutive silver supply deficit has been officially confirmed. Ladies and gentlemen, analyst here. The neckline at 92 is 5% away. The battle starts now. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. Let me decode the structural anatomy of today's session, because 4 consecutive advancing days and a 6% single session surge carry a specific technical message that goes well beyond the headline number. Silver closed last week at $82.34. The question entering this week was simple. Does the market consolidate or extend? The answer came in the first session. Reports confirmed silver jumped 6% intraday, trading between $86.90 and $87.30, its highest print in over 2 weeks. During the European session, the confirmed price was $86.40, up 2.22% from Friday's close of $84.52. Year-to-date as of February 23rd, silver has now advanced 21.54% in 2026. That is the strongest 23-day start to any year in recent silver history. 4 consecutive higher closes is not a speculative spike. Analysts note that a sustained sequence of advancing sessions represents systematic buying pressure, each session finding new buyers willing to pay a higher price than the previous close. This is the behavioral fingerprint of genuine conviction, not momentum chasing. Sources confirm silver was trading around $87.10 during Asian hours on Monday, representing the 4th straight session of upward price discovery. Let me give you the structural anatomy. Think of the 20-day exponential moving average as the market's center of gravity. The level price tends to return to after extremes in either direction. This average sat at $82.78 on February 23rd, and analysts note it has now stabilized and begun curving upward. When the center of gravity itself shifts direction from declining to rising while price is trading above it, the technical community recognizes it as a trend improvement signal. The market's own structural framework is confirming that the recovery has become a directional move. The February 4th session high at $92.21 stands as the next confirmed resistance target above current price. From 87 to 92.21 is 5.4%. A market that delivered 6% in a single session holds the mechanical capacity to cover 5.4% in 2 to 3 sessions of follow-through. Reports note the psychological level of $70 remains the secondary support floor, with $64 as the ultimate structural anchor established by the February swing low. The gold-silver ratio dropped to 59.50 on February 23rd, down from 60.30 at Friday's close. Sources confirm silver outperformed gold by 3 times in percentage terms on the same session. When the ratio falls and silver leads gold by a factor of 3 in a single day, it signals that capital is actively rotating towards silver as the higher leverage precious metals instrument within the complex. The ratio compression below 60 is a structural momentum signal that historically precedes the most aggressive phases of silver's relative outperformance. The architecture of the market is saying one thing: the next leg is silver's leg to lead. 3 fundamental forces converged on February 23rd to produce the 6% session, and each force is independent, structural, and not going away before the week ends. Force 1, the tariff triple-layer escalation that the market had not yet fully priced. Reports confirm that on February 23rd, President Trump posted to Truth Social announcing the global baseline tariff would rise immediately from 10% to 15%, the maximum legally permitted level under Section 122 of the Trade Act of 1974. This provision, as sources note, has never previously been invoked by any U.S. president in the law's 52-year history. It authorizes temporary import surcharges up to 15% for a maximum of 150 days to address balance of payments deficits. The White House confirmed the underlying 10% surcharge took effect February 24th at 12:01 a.m. Eastern Time, with the 15% escalation running simultaneously. Critically, sources confirm that all existing Section 232 tariffs covering steel, aluminum, and copper at 50%, automobiles at 25%, and pharmaceuticals at 100% remain fully in place and were not affected by the SCOTUS ruling. New Section 301 investigations have been launched against most major trading partners. The trade policy architecture is not collapsing. It is reconstructing itself into a more durable, legally rooted, multi-statute framework with more enforcement vectors than the original emergency powers regime had. For silver, the tariff escalation creates a two-channel demand stimulus simultaneously. First, trade war uncertainty drives capital into hard assets as hedges against currency and supply chain instability, the monetary safe haven channel. Second, industrial procurement managers respond to a 15% blanket tariff by accelerating silver stockpiling before tariff-driven cost escalation makes physical acquisition more expensive, the industrial pre-buying channel. Analysts note that silver, as a critical mineral embedded in semiconductors, electronics, and electric vehicle supply chains, sits directly in the crossfire of tariff-driven industrial cost transmission. The incentive to accumulate physical silver inventory ahead of Section 301 escalations is both real and immediate. Force 2, Iran unresolved. Reports confirm that on February 23, while diplomatic contacts continued through back channels, Trump explicitly stated that limited military strikes on Iran remain under active consideration if nuclear negotiations fail to satisfy U.S. conditions. Analysts note that the dual-track nature of the U.S.-Iran situation, simultaneous diplomacy and active military positioning, creates maximum sustained uncertainty because neither outcome can be priced with confidence. An unresolved standoff is more dangerous for market stability than a resolved conflict, because the resolution event itself, whichever direction it goes, can be planned for. An ongoing standoff cannot be planned for. It simply maintains the risk premium day after day. Force 3, the sixth consecutive deficit confirmed by the industry's own research institution. According to the Silver Institute's February 10th annual market outlook, relying on analysis from London-based Metals Focus, the global silver market will enter its sixth straight year of structural supply-demand imbalance in 2026, with a confirmed shortfall of 67 million ounces. Sources confirm total global supply is forecast at 1.05 billion ounces, the highest level in a decade, yet it still falls 67 million ounces short of total demand. Mine production is edging up 1% to 820 million ounces, but physical investment demand is projected to rise 20% to 227 million ounces, a three-year high, as Western investors return after 3 consecutive years of declining participation. Meanwhile, AI data centers alone are expected to require an additional 67.5 million ounces of silver by 2030, as Goldman Sachs projects a 165% expansion in global data center power consumption. That demand is not discretionary. It is capital expenditure committed by the world's largest technology companies. It does not cancel because of tariff rulings. It does not pause because of Iran negotiations. It compounds year over year, session over session, quietly pulling the floor higher beneath every tactical trade in this market. The sentiment shift on February 23 has moved from tactical safe haven buying into structural portfolio reallocation, and the distinction matters enormously for understanding how durable today's advance is. Tactical safe haven buying is what happens when a single event, an Iran headline, a tariff announcement, drives price up for one session before profit-taking reverses part of the gain. That is episodic. It does not build lasting price floors. What happened on February 23 is structurally different. It is the fourth consecutive advancing session, after the prior week's 5.62% weekly gain. The market is not responding to one event and fading. It is building a staircase, session by session, with each step supported by a different combination of catalysts that prevents any single reversal from undoing the sequence. The gold-silver ratio at 59.50 is the sharpest single sentiment indicator of the day. Sources confirm this represents the ratio's third consecutive day of decline, meaning silver has outperformed gold 3 sessions in a row. The Silver Institute's annual outlook published February 10th noted that at the peak of the January all-time high rally, the ratio dropped below 50 for the first time since 2012, driven by institutional and speculative convergence on silver's superior leverage in the precious metals complex, the ratio recovering toward 60 after the January crash, then resuming its decline toward 59 and below. Is the market revisiting its structural conviction that silver deserves to trade at a tighter premium ratio to gold than 60 plus? Bitcoin's decline below $65,000 on the same session adds the cross-asset confirmation. Reports confirm crypto markets reacted negatively to the tariff uncertainty and Trump's executive response to the SCOTUS ruling. This behavioral data point is important. Bitcoin's core marketing proposition, that it functions as digital gold and a hedge against government policy risk and dollar debasement, was tested directly on February 23. A 15% global tariff, a Supreme Court defeat for the executive branch, and a Middle East military standoff all activated simultaneously. Bitcoin fell, silver surged 6%. The real-world behavior of these two assets under genuine macro stress exposed the gap between the marketing proposition and the operational reality. Capital that needed genuine macro protection on February 23 chose silver, not Bitcoin. Sources note that China suspended trading in certain commodity-linked funds during the peak January volatility period, creating a pool of held-back Chinese institutional silver allocation. With Chinese markets fully reopened and fund trading restrictions lifted, this held-back allocation is now available to re-enter a market that has already advanced 6% without it. The convergence of Chinese buyer re-entry with the tariff activation date of February 24 creates an accumulation window that forward-looking institutional participants began positioning into during today's session. The Silver Institute's investment demand forecast anchors the structural floor, physical bar and coin demand projected at 227 million ounces in 2026, a 20% increase, three-year high after 3 consecutive years of Western investment declining, as analysts note. This 20% physical investment growth projection is not derived from geopolitical headlines. It is derived from the structural observation that silver's extraordinary price performance in 2025 combined with persistent macroeconomic uncertainty creates a durable floor for safe haven physical demand that is independent of any single quarterly news cycle. When the world's leading silver research institution projects a 20% rise in the category most resistant to sentiment swings, physical coin and bar, the sentiment floor is not a trading desk's hope. It is a structural forecast backed by observable purchasing behavior across retail and institutional physical markets globally. Let me now compare silver's February 23 session against every other asset class and available safe haven alternative, because relative performance is where the structural argument becomes undeniable. Gold reached $5,160 per ounce during Asian hours on February 23, up 1.61%, its highest level in over 3 weeks per market reports. Silver was simultaneously gaining 6%. The 3-to-1 outperformance ratio is not an anomaly in this particular macro environment. It is the direct output of silver's dual demand structure. Analysts note that industrial demand constitutes 55 to 60% of total silver consumption, a share that gold simply does not possess. When a 15% tariff activates across global trade, it creates an industrial procurement urgency for silver that has no equivalent in gold's demand structure. Gold benefits from one channel, monetary safe haven. Silver benefits from two, monetary safe haven plus industrial pre-buying. Two channels multiplied by the same macro event produces a larger price response. The math is structural, not circumstantial. The year-to-date comparison adds a second dimension of comparative superiority. Sources confirm silver's YTD gain stands at 21.54% as of February 23. The same metric for gold is tracking below 10% for the identical period. Silver is outpacing gold's 2026 gain by more than double over the first 23 days of trading. For investors and asset allocators comparing precious metals positions, this comparison delivered by the market's own price discovery is the clearest possible argument for silver's relative value within the complex. Section 232 tariffs on copper at 50%, steel and aluminum at 50%, and automobiles at 25% are legally durable and permanent, as sources confirm they were unaffected by the SCOTUS ruling. Silver's applications span all of these tariff-affected supply chains: copper wiring and electronics where silver provides superior conductivity, aluminum and steel-intensive automotive manufacturing, where silver is embedded in circuit systems and batteries, pharmaceutical packaging where silver's antimicrobial properties are deployed. The tariff architecture that Section 232 has built around these supply chains permanently elevates the cost transmission mechanism that incentivizes silver stockpiling. This is not a 150-day dynamic like Section 122. This is the permanent tariff backbone that silver supply chain managers must operate within indefinitely. The honest counter-argument: Section 122 expires in 150 days, unless extended by Congress. Treasury Secretary Bessent has acknowledged alternative tariff mechanisms are less powerful than IEEPA. If the tariff headline premium fades as the legal limitations of Section 122 become more widely understood, some of today's tariff-driven gains could retrace partially. Analysts note this scenario produces a pullback toward the 82 to 85 range, not toward 64, because the structural deficit, the AI demand build-out, and the Section 232 permanent tariff framework all provide an independently sourced price floor that does not expire in 150 days. The Silver Institute's measured assessment of the market's current trajectory is direct. The global economic and geopolitical environment is likely to remain supportive for precious metals prices in 2026. Physical liquidity in the London silver market may remain relatively tight. This language, coming from the industry's primary research institution rather than a trading desk's promotional material, represents the most conservative, credible validation of the bull case available. When the institution responsible for tracking global silver supply and demand tells the world that tightness and geopolitical support are likely to remain features of the market in 2026, The contrarian who bets against those two factors is betting against the fundamental architecture, not against sentiment. Here is the battle plan. Precise, level by level, no ambiguity. Your structural anchor, $64. The February swing low, the base of the right shoulder. Uncontested since the first week of February. This is the level that defines the thesis. It has not been challenged in nearly 3 weeks. Every session above 64 extends the structural validity of the current advance. Your moving average defense, $82.78. The 20-day exponential moving average confirmed as stabilized and turning higher. Analysts note this level now acts as the first line of tactical defense. Any pullback that holds above 82.78 is a consolidation event inside a bullish structure, not a reversal. A close below this level requires reassessment of the short-term breakout thesis, but does not invalidate the 67 million ounce structural deficit argument. Your current operating zone, $86.90 to $87.30. The confirmed intraday range on February 23, 2026. This is the 4th consecutive advancing close. This is the launch pad for the neckline assault. This is where the diamond hands are positioned. Your first intraday target this week, $90. The psychological round number that serves as the gateway to the neckline zone. No technical resistance is specifically confirmed at 90, but round numbers create their own friction. A close above 90 signals the shift from recovery narrative to bull leg 2 narrative, and that narrative shift activates a new wave of institutional buyers who have been waiting for confirmation before re-entering. Your primary structural target, $92.21. Sources confirm this is the February 4th session high. The next confirmed resistance level above current trading, representing the neckline activation zone of the inverse head and shoulders pattern. From the current $87 zone to 92.21 is 5.4%. The tariff activation on February 24th, China's full physical market re-entry, and the ongoing Iran standoff all provide the fuel to cover 5.4% in 2 to 3 sessions. Your measured move target, $104. The structural completion of the inverse head and shoulders based on the anatomy from the $64 head to the 92 to 94 neckline. When 92 is confirmed on a closing basis, 104 is the mechanical price objective. This target does not negotiate with tariff courts or diplomatic timelines. It is set by the pattern's geometry. Now the two scenarios for the week of February 23rd through 27th. Scenario 1. The tariff ignition continues. Section 122 surcharge activates February 24th as announced. Industrial silver stockpiling accelerates as procurement managers act ahead of potential Section 3.01 tariff escalations. China's fully reopened buyers enter a market that just moved 6% without their participation. Iran military action triggers the final safe haven leg. Silver approaches 90 before the week ends. 92 is contested in the first days of March. Diamond hands holding from 82 to 87 through the recovery ride. The measured move toward 104. Scenario 2. The legal hesitation. Market participants focus on the 150-day expiration clock of Section 122. Dollar partially recovers as tariff permanence is questioned. Silver retraces to the 83 to 85 zone over 2 sessions before the buying pressure returns. The 20-day EMA at 82.78 holds as support. The pause extends the right shoulder construction, while the structural deficit and geopolitical standoff maintain the fundamental floor. Every touch of 83 to 85 in this scenario is a precision entry for the 92 target. Both scenarios lead to the same destination. The path is the only debate. Comment below with Section 122 live on February 24th and China's buyers fully re-engaged. Does silver reach 90 before this week ends? Your read matters. State your position. This is the analyst. The 4th day strike has executed. The neckline stands at 92. 104 is the measured move target. The diamond hands hold, the weak hands are already gone. See you at 92. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.